What central banks are doing is extremely important for the plumbing of the financial system to provide liquidity where it's needed. But that's just obviously a portion of the problem. That's kind of like intubating the patient. But we've got other problems in the credit markets, much of which is tied to the crash in oil prices and what's happening with OPEC, which of course is sadly completely separate from the virus. But I think the nature of the virus, the rampant uncertainty associated with it, on a day-to-day basis, the massive cuts you're starting to see to second quarter GDP forecast, to as deep as, more than a 20% drop, depression era kind of drop in GDP, and in turn, a spike in some cases by some estimates to a couple million in jobless claims. So I think the nature of this, given that we know it's getting worse before it's getting better, it's just hard to imagine that we establish a true bottom until we have a better sense of when we're in the end game for the impact of the virus.
Mike, Lizanne brought up an interesting point about credit, which does seem to be some of the root of the problems for the overall market right now. Can you just talk about the corporate debt problem out there right now, why it's gotten so big, and what these companies are going to do if they can't service their debt with the economy basically halted?
Yeah, I mean, you've had the market essentially, in a week's time, radically ramp up its estimate of how many companies simply cannot service their debt. We always knew that there was, a fairly large non-financial corporate debt load out there. So at the same time that you've had revenues sort of come to a standstill, balance sheets all of a sudden that looked okay now don't look okay. You also saw end investors rushing away from corporate bond funds and everything like that. So that added just liquidity stress on top of everything else. So if that's the case, and I think, by the way, that's emblematic of this very, very tricky situation of trying to figure out how to navigate the market and how to decide what the pain to the economy is going to be, because if it's a few weeks, then we can get back and the Fed perhaps can bridge us there and Congress can put a little bit of a cushion underneath companies and consumers. If it's months, then no business was run to not have revenues for months. So I think the Fed is doing what it can to liquefy those parts of the credit markets and the parts of the fixed income markets that do have these clogs in them. That's sort of effective at the margin, but it's not really solving the entire issue. And if that's the case, then equities are going to just price in that rising default risk and all the rest of it as it goes along. So that's why that's been kind of the central focus for a while now.
Mm-hmm. Lizanne, for those investors that are watching and want to dip their toe into the market, being aware that they have to be a long-term investor to feel it is indeed a buying opportunity, how should they weigh up which stocks or which sectors to go for? Are typical metrics like P/E ratios out of the window right now?
I think valuation is completely out of the window right now because we've got both the denominator and the numerator basically imploding. And what's unique about this particular, crisis is that instead of just guiding down, as companies will often do in a typical, pre-recession downturn, most of them that are most hit by this are simply withdrawing guidance. So that's why you see a lot of firms just go to a blanket, okay, we think earnings are going to drop by X%, as opposed to it being a function of bottom-up analysis. Also, valuation, I think this is really important. We think in a normal environment, the valuation is this fundamental metric because the two components of it, the P and the E, are typically quantifiable. But the reality is valuation is as much a sentiment indicator as anything else. So even if we had some confidence in the E in this case, the issue, though, is what are investors willing to pay? Yes, you can look at macro conditions that historically generally support a higher or lower P/E ratio, but we also know that extremes in the market, a la 1999, 2000 on the upside, 2009 on the downside, fear and greed take over and take valuations to, a stretched extreme in both directions. So you've got the sentiment angle, too. We've just been telling investors that maybe take a more, first of all, if you're disciplined using diversification, all those tried and true disciplines, which is really the only thing close to a free lunch you get in an environment like this. But if you have the ability, because of the tax structure of the portfolio, to maybe consider rebalancing a bit more frequently and having it be kind of the trigger come based on volatility and how quickly asset classes are sort of moving in or out of whack, and maybe take advantage of that. But I would also suggest a dollar cost averaging approach, both on the adding side and the trimming side, as opposed to trying to kind of pick a day to do it.
Got it.